Global trade is collapsing. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a shocking collapse in global trade indicates there's no end in sight for what is already a global economic slowdown. And for businesses, they're now struggling for survival as we have more signs that they're sitting on far too much inventory and demand is outright collapsing. And the reason global trade is so important is because when trade is expanding, the global economy is expanding. When it's contracting, as we're seeing now, it says bad omens as we head into the second half of the year, which, as we detailed in yesterday's show, was already going to see a huge collapse in demand. But are we possibly in a recession already? Well, some shocking government data now indicates that perhaps in the first quarter, we're already one step down the hole of a global recession. Let's over to the Wall Street Journal, where we picked today's story up with a headline: container shipping is cratered as ship owners try to avoid unprofitable trips. Now, this is a huge turnaround because you may remember not too long ago, there was such a demand that prices for container ships were just getting bid up higher and higher and higher. Now we're seeing the complete opposite, where there's so much capacity that they're actually starting to lose money. And this is a huge problem because it all comes back to the fact that without all this pandemic stimulus and monetary and fiscal stimulus, that's all wiping out demand, particularly as we're seeing people being forced to pay back on their debts. We're going to see more of that later this year, and the story of collapsing global demand is only going to accelerate to the downside. It is an ominous sign that the shipping industry approaches its peak season. Demand normally rises during the summer and early autumn as retailers bring in higher levels of merchandise for crucial selling periods, such as the year-end holidays. That what we're seeing is ship operators say they need freight rates to increase to cover their operating costs. For now, there are too many ships in the water bidding for cargo, resulting in a heavy competition in prices. Now, you may remember back during the pandemic when we had too few ships. So what happened? Everybody cranked out, said we need to go out and build more ships, larger ships, increase capacity. Because if you recall, what was the broad belief as we came out of the pandemic was this is the new normal. Everybody over the last 10 years has just been holding back on their consumption, and now they're ready to consume at even bigger levels. And really all it was effect of that fiscal stimulus that was weighed upon the U.S. economy. It was borrowed heavily, and of course the low interest rates from the Fed didn't hurt either, and it just created this perfect storm. The problem is everyone bought into the story that it would last forever. Cargo volumes into the U.S. slumped this year amid a broad decline in orders from retailers and manufacturers, as we've been showing you in the reports, particularly the Fed surveys, as the nation's busiest container port complex at L.A. and Long Beach handled the equivalent of about 1.474 million import containers, a 32% decline. So here you have one-third of all containers coming into the busiest port on the West Coast are in decline. Again, it's all a demand story, and this is why we've been talking about new order demand is so critical, because when new order demand falls, of course, it means you need fewer employees, there's less demand, and all of a sudden it's being validated here in the global trade data. As peak season hope fades as container freight rates slip again, and a prospect of traditional peak season is slipping away, it says eventually those inventories will need replacing for the holiday season, as nobody wants last year's product. But notably, they're not seeing any drastic surge. Now, here's the question though: if you start looking forward to the holiday season and you know that the government spending isn't going to be much bigger, in fact, it's going to be a little bit smaller, so we're going to see a cut in spending. If you see all these student loan repayments coming back in September, what do you think this means for the holiday season? Do you think people are going to be demanding the latest and greatest things, or do you think they're going to be trenching in and saying, you know what, I don't care if it's last year's product or 3 years product ago, I can't afford it anyways? I'm going to guess that retailers are going to be stuck on this inventory a lot longer than they want to. Container shipping now under pressure as peak season hope dims. Progress on inventory destocking, but concerns on consumers. Now, this is exactly what we're talking about here, because inventory destocking has gone longer than expected. Now, what does that mean is there was this belief that all of this inventory, well, it was just a matter of time before consumers came out, spent the money, and drew it down to normal levels so we could see, of course, new order growth pick up and trade pick up. And what are we starting to hear? We've talked about this from some of the companies companies we've covered during the earnings report. What are they saying? Consumer demand is down. Inventory levels aren't coming down as quickly as we want, and it seems to be a broad-based issue. As pressures on consumer demand are building, trans-Pacific shipping capacity is not down as much as predicted, but spot rates are bumped up mid-April since ease. And the talk now is about a more moderate peak season at best. And the issue is central focus of the analyst client notes this week following Home Depot and Target. Home Depot said inventories were still up 60% in nominal terms. On the consumption side, he pointed out that Home Depot unit demand is back to pre-pandemic levels. So again, all of this hope that, all this pandemic spending was going to continue, well, it couldn't continue because people stopped getting checks from the government, which is what fueled all the spending rage. As far as Target, their inventories were down 60% year on year, but up 30% from Q1 2019, implying unit inventories about flat versus 2019 when adjusting for inflation, also implying that it's still too high. And even though companies are trying to suggest that maybe they've got this under control, well, when we look at this chart of retailers' inventories, here is the baseline for pre-pandemic, which you note is kind of normal that you see during an expansion, inventory levels rise, and then as the economy turns down, they need to get drawn down. Well, here we were at kind of the peak going into the pandemic. The red line suggests where it could be if we were back to that level. We're well above normal. And so the problem is there isn't enough demand to draw down these inventories. And when that happens, well, you don't need as many ships moving cargo. And container ships are moving at all-time low speeds of all things now, suggesting and validating what we've been saying here. But one thing that shouldn't be moving at all-time slow speeds is your trading account. Here we're going to talk about our CTA-Timer Pro product. And mind you, if you're trading the tech stocks and you missed it, we showed you the buy signal here. We showed you a buy signal there. Here it is on January 9th. There was a buy signal coming out of a deep short position. This was the indicator for you to start buying. Happened again March 15th. After that pullback, the machine started buying. The report says buy here, and many of you saying, look, if this thing can nail the reversal in tech, and don't worry, I'll show you when it happens that you're in on it, and don't worry, you'll want to be, because it's $30 a month right now. At some point, I'm raising it to 40. It's going to change how you trade. As one person sent me an email today, said it makes trading all of a sudden fun. And let's continue on. Because container shipping has been relying on one of his top tricks in his playbook to rein in the worst markets by going super slow. And notably, they're suggesting the ships could go even slower. So why would they do this? Well, you just turn back the throttle and hope, well, maybe by the time we get there, some of this inventory will draw down, and this inventory that we have, there'll be greater demand for it. Maybe we can get a higher selling price. Maybe there's just need for it. Because the problem is you show up with inventory that no one really needs and just gets piled up, and next thing you know, more lack of new orders come down the pipeline. Factory orders start to slow down. You need fewer employees. It's just kind of a chain reaction here. So the old adage is, well, if you don't need it there, well, we'll get it there a little later. The record avalanche of new builds coming from yards in Asia are being injected into services. And now we see Metre and MSC announced this month they would be injecting 9 additional vessels into the Asia-Europe trade, while at the same time adding that these services would be moving up to 3 days slower than before, thus absorbing all the new capacity. So, not only do we have too much capacity now, we have more capacity coming online, and it's all just causing a perfect storm. As freight carriers are hoping to rebound as retailers finally sell down post-COVID inventory, this headline makes no sense considering we just showed you that inventory levels were far too high, but yet freight carriers remain in focus, according to Wall Street Journal, stuck with tons of inventory coming out of the COVID pandemic, but they're chipping away at it, they say. Inventory at retailers like Walmart and Target are lower, but the problem is they're still too high by the normal phase they should be in, and by golly, if we head into a recession, these inventory overhangs are going to be so massive. You're going to see deflation coming out of the retail and wholesale space because they'll be so desperate to get rid of all this inventory, because every month that goes by, every quarter that goes by, the inventory gets older and older and older to the point where I find out where perhaps nobody actually wants it. And this is a problem that Macy's is facing. As mood darkens at Macy's as retail spending slows. Retailers have finally worked through piles of excess inventory. Well, not quite. That tripped them up a year ago. Now they're facing another problem, as we've said was going to happen. Slowing demand for Macy's, its apparel and accessories. And here we can see they cut their full year outlook on sales and profits, citing challenges in the economic health of consumers. And boy, if they think it's difficult now, wait till the student loan repayments kick in. But one thing that does appear to look good, at least still for a while, the U.S. labor market. This from the ADP. As private employers added 278,000 jobs in May, the question is, where did they come from? Well, not exactly the place we wanted, but get this. According to their chief economist, this is the second month we've seen a full percentage point decline in pay growth for job changers. Pay growth is slowing substantially, and wage-driven inflation may be less of a concern for the economy despite robust hiring. So what the question we're going to look at as we get into this report is, where is the hiring at? Well, we talked about this in the last couple of shows, is going into the summer months. What do you see typically hiring for? Leisure and hospitality. The concern is that inflation isn't coming down fast enough, but all of a sudden wage growth is starting to crater here. And this is an indication of what? Well, lack of demand for labor on one side, but if you don't have a loud demand in new orders and consumption, well, you don't need to keep paying your employees a whole lot more money. Here we can see that most of the hiring was done by small and mid-sized employers, and while larger employers, as we know, have cut jobs. But look at this, and change by industry. On the good side, we see natural resources and construction adding. Manufacturing, as we noted, is down. But look at the services sector. We get some transportation has some jobs, but here's the big one. Look at this, leisure and hospitality, 208,000. Just as we said, heading into the summer months. Of course, the question always remains is, will there be demand through the summer, or are we seeing a slowdown at the worst possible time? But there's one indicator that says we may have started in a recession in the first quarter, and that is something very few people actually look at. Here we have non-farm productivity on quarter over quarter down 2.1%, and unit labor costs increasing to 4.2% year over year. But let's take a look at why these matter, because when you think about productivity, if you're a brand new hire, let's say you're coming out of college, you get your first job, and you go there on the very first day, you're not very productive because, well, you don't know where anything is to begin with. You got to find your desk and all those other things that go along with it. It takes a long time to get in the flow of how to do your job, how to work with other people, what you're going to do to become highly productive. So in the pandemic, what did we see? What happened is a lot of productive older workers, well, they retired. So we brought in a lot of younger, unproductive workers. Not that they in themselves are unproductive, they just didn't know the job like people who had been on it for 20 or 30 years. So what should happen over time is we should see productivity start to increase as these unproductive workers become skilled at their job and can do more and more. Now, what happens though is during a recession or leading into recession, even though they're becoming more productive because they've been time on the job, if there's a lack of demand, a lack of work for them to do, well, their productivity actually falls. Now let's first look at unit labor costs. This being validated by the ADP, suggesting that unit labor costs for all workers are slowing down, and this is highly disinflationary. We have in red the consumer price index because it's very simple relationship here. If workers are not making higher wages, they're not going to be able to spend as much, particularly when their debt load comes back. So let's take a look at this non-farm productivity, because what we should see coming out of a recession or a slowdown is an increase in productivity as those unproductive workers become more productive, and there's enough demand in work to validate they're being more productive. But what happens if you see a downturn like we did and it stays down like we're seeing now? You see here it's kind of rebounding, but it's still not doing very well. Well, that is an indication of a recession. We see such a trend every time a recession. It also means that, of course, that inflation is likely to come down. We can see in these other indicators, inflation came down here. We see inflation came down. And what it's telling us is, as the trade industry, the freight industry, the shipping industry has been screaming at us to tell us the global economy is slowing here, and that means workers aren't going to be more productive. That means they're not going to get bigger raises, and in turn means inflation is coming down, and that a recession is almost a certainty for the second half of this year. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye. Bye now.